As of right now, Monday, February 2, 2026 at 10:46 a.m. Eastern Time, SMX Security Matters PLC is trading at $12.83 on the NASDAQ. This represents a sharp intraday drop of 6.55% since the opening bell, where the stock actually started much higher at $14.44. We are seeing a significant amount of volatility today, with a session high of $14.44 and a session low of $12.53, and this downward pressure is exactly where the tension between investor expectation and the cold reality of the tape begins to show itself. Most people looking at a company like SMX expect a penny stock that lives or dies on press releases, but the reality is that the market is currently digesting a massive shift in the company's capital structure that has completely changed the math for anyone trying to trade this name. While the casual observer might just see a falling red line on their mobile app, the insight you might not have anticipated is that SMX recently converted over $20 million of debt into equity. On paper, that sounds like a win because it cleans up the balance sheet and removes those high-interest liabilities that can sink a small-cap tech firm. However, the reality hitting the market today is the dilution that comes with that conversion. When debt becomes shares, the total number of shares in the float increases, and if there isn't enough buying pressure to soak up that new supply, the price naturally starts to sag. We are seeing that play out in real time as the stock struggles to hold the $13 level. The common ground here is that everyone knows SMX is a high-risk, high-reward play in the ESG and supply chain tracking space. The general belief is that if they can just land one major contract with a global gold miner or a massive plastic producer, the stock will return to its former glory. But the deeper, more contrarian take is that SMX is no longer just a story stock. It has moved into a phase where the market is demanding actual revenue and proof of concept over technical white papers. Investors are tired of the what-ifs and are now focused on the how much. Today's volume of over 350,000 shares, which is a decent clip for this time of day, suggests that institutional players might be shifting their positions as they evaluate whether the company can survive without constant equity infusions. When you look at the recent movement, SMX has been on a wild ride. Just a few weeks ago, in mid-January, the stock was hovering in the $22 to $24 range. To see it sitting at $12.83 today is a brutal 50% haircut in less than a month. This isn't just a random dip, it's a repricing. The market is looking at the 52-week range, which is absolutely staggering, from a low of $3.12 to a high that essentially reflects a different era of share structure. Technical indicators like the 50-day and 200-day moving averages are currently screaming sell because the price is trading so far below those levels, creating a massive overhead resistance. Every time the stock tries to rally, it hits a wall of sellers who are just looking to break even. Let's talk about what SMX actually does, though, because the business model is actually fascinating if you can look past the price share for a second. They specialize in molecular marking. Essentially, they can tag physical materials like gold, plastic, or rubber at a molecular level. This creates a permanent, unalterable record of where that material came from and where it has been. In a world where companies are desperate to prove their green credentials and avoid blood gold or illegally sourced materials, this technology has huge theoretical value. They even recently opened a corporate account with Kraken, which signals they are trying to integrate their physical tracking with digital assets or a plastic cycle token. But here is where expectation hits reality again. The expectation is that the world is moving toward a circular economy, and SMX has the keys to that kingdom. The reality is that implementing molecular marking across a global supply chain is incredibly expensive and slow. It requires cooperation from miners, refiners, and manufacturers who are often resistant to new costs. This is why the financial health of the company is so scrutinized. If they spend all their cash before the revolution in supply chain transparency actually happens, then the technology doesn't matter. The recent conversion of notes was a move to extend their runway, but it came at the cost of current shareholders' equity. When you look at the broader landscape of online investing right now, people are comparing SMX to other high-volatility plays. On the Robinhood app or through an individual brokerage at Fidelity, retail investors are trying to catch the falling knife. We've seen a lot of chatter on social media about SMX being undervalued because of its market cap, which is currently sitting at around $128 million. For some, that seems like a steal for a company with patented molecular technology. But for those using sophisticated tools like interactive brokers or even the research tools within Schwab Intelligent Portfolios, the focus is on the burn rate and the lack of a clear path to profitability. Engagement is key in these volatile markets because sentiment often drives price just as much as fundamentals. I want to hear your thoughts on this. Comment below with how many shares of SMX you are currently holding, or if you've completely exited your position after this recent drop. Do you think the molecular marking niche is too early for its own good, or is this just a temporary shakeout before a massive move higher? Looking at institutional activity, we haven't seen the big smart money names like Vanguard or BlackRock piling in with major convictions lately. Instead, the volume seems to be driven by smaller hedge funds and day traders who thrive on the 5 to 10% daily swings. When you see a stock gap down from $14.44 to $12.83 in a single morning, that's usually a sign of stop-loss orders being triggered. This creates a cascading effect where the price drops, more stops are hit, and the price drops further. It's a vicious cycle that often only ends when the stock hits a level of absurd value where buyers finally feel the risk is worth the reward. Moving into the future outlook, there are a few catalysts to keep an eye on. First is the adoption of the plastic cycle token. If SMX can prove that this token has real utility in the recycling market, it could provide a secondary revenue stream that isn't dependent on physical marking fees. Second is the gold industry. If more central banks or major exchanges mandate molecular verification for bullion, SMX could be sitting on a gold mine, literally. However, the risk is that a larger competitor with deeper pockets could develop a similar technology, or that the current share dilution continues until the stock price is back in the single digits. In the world of online investing, it's easy to get caught up in the hype of disruptive tech, but SMX is a case study in why the balance sheet matters just as much as the product. Whether you're using a self-investing approach or getting investment help from a professional, the numbers on the page don't lie. The stock is currently in a confirmed downtrend, and until it can find a floor and hold it with significant volume, it remains a dangerous place for most portfolios. The expectation was a clean breakout after the debt was settled, but the reality is a market that is still worried about the total share count and the company's ability to execute on its global partnerships. We see this often with tech firms that have a great idea but a difficult path to commercialization. They spend years in the pilot phase, and while those announcements look great on a website, they don't always translate into a positive bottom line. As we wrap up this look at SMX, the central insight is that today's price action is a reflection of a company in transition. It's no longer a debt-burdened startup, but it is now a heavily diluted public entity that has to prove its worth every single day. The contrast between the high hopes for its technology and the harsh reality of its recent 50% drop is a reminder that in the stock market, the story is only as good as the chart. Stay sharp, keep an eye on those volume bars, and make sure your risk management is as solid as the materials SMX is trying to track. The move from $14.44 down to $12.83 today is just one chapter in a much longer story of a company trying to find its place in the modern supply chain. Whether it ends up as a success or a cautionary tale depends entirely on the next few quarters of execution. If you found this analysis helpful for your own self-investing strategy, keep digging into the data and never take a single price point as the whole truth. Would you like me to look into another ticker like Tesla stock or Nvidia stock to see if they are facing similar dilution issues?